Hi, it's Nero here from Investment Rise, and let me ask you a question. Were you someone who was thinking of buying an investment property earlier on in this year and then saw the COVID-19 pandemic and freaked out, especially believing all these scary headlines about property prices falling? Or are you someone who's thinking about buying an investment property right now and you're just wondering, well, is now the right time to buy? Should I wait a bit longer? Well, if you're in either of these two situations, then I really hope that this will help you, because today I want to talk about how the announcement that the Reserve Bank of Australia made was the fifth and what I believe the final factor determining why we're about to have a large property boom that's actually already started. Oh, and mind you, that announcement that I'm talking about was not the interest rate cut that it provided. So what was it? Well, stay tuned, but let's first begin with some background. As I record this video in earlier November, we've had data come from CoreLogic talking about the October price data. We've had our first month of average price growth in Australia, and that's the first month since May. Now, that does not mean that some areas have not been growing throughout this pandemic. In fact, surprisingly, there have been areas in different cities that have been growing right throughout this pandemic. For example, houses in the northwest of Sydney have seen prices rise. Houses in the Sunshine Coast in Queensland have seen prices rise. But right now, for the first time, on average, Australian house prices are starting to grow. And that's the first time since May. National house prices are up on average 0.4%. And again, I'm talking about average house prices here, because it's clear though that all the doom and gloom about house prices from a few months ago, well, it was completely inaccurate. I mean, if you go back to some of my messages back in April and even March, when I said that I expect house prices will plateau, yes, there may be a slight pullback, but don't expect a huge crash. Well, according to CoreLogic, between March and September of 2020, prices dropped on average by just a tick over 2%. Is a 2% price drop in property anything to be scared about? I wouldn't think so, right? It's just your normal fluctuations. So for everyone out there who was pushing an agenda of property prices dropping by 30 or 40%, the data clearly shows they were totally and utterly wrong. We now have our first month of property prices rising, and in fact, even if you look at the last month, Melbourne was the only market that prices didn't grow in. But the Melbourne house market went back on average by a grand total of 0.2%. So consider this, Melbourne, the city that's been impacted the worst by the coronavirus pandemic in all of Australia, and last month, its average property prices dropped by 0.2%. And now, in the first auction since the lockdown was lifted, we're seeing clearance rates there of 70%, which is well above the long-term average. So I expect that even Melbourne will start to see some average price growth in the next quarter, although I expect it'll be less than most of the other markets around Australia, because their economic fallout as a result of this extended lockdown and the second lockdown that Melbourne had, that still needs to be absorbed. But if we keep going and look at some of the other data right now, freestanding houses across Australia, so not apartments, freestanding houses, we're starting to see rents increase. And mind you, I expect this will continue because the freestanding house market, okay, so we're talking detached houses, in many areas is starting to go into undersupply. So when you look at the actual supply, and by that I mean properties coming onto the market to be sold versus properties that are being sold and taken off the market, it's actually at a 10% deficit according to CoreLogic. Put another way, our house market, again, I'm just talking about freestanding homes here, it's currently being undersupplied by about 10% when we compare properties coming onto the market versus properties being sold and taken off the market. And I think this situation is only going to increase because, according to the Housing Industry Association of Australia, or HIA, it's currently showing, the data from them is showing 12 to 15% less approvals in both the unit and house market across Australia, yes, even the unit market. So we've got rents rising and an undersupply, especially in the house market. Now, these are two factors that are gold for anyone who's looking to buy an investment property for capital growth. But it actually gets a lot more exciting than that. Because, you see, we've got rents increasing. We've also got interest rates dropping. And I think that you're going to see more opportunities to find properties that are growing in value and providing you with positive cash flow, providing you with a net income each and every month. We've never seen this opportunity before. This is such a rare opportunity to find property that's going to give you both a positive cash flow and good capital growth. I mean, imagine how it would feel to have an investment property that's paying you net income each and every month, so all your expenses are taken care of and it's giving you a bit extra. Plus, it's also rising in value. How many of those would you want to buy and how quickly? Right? And then when we consider that we have cheaper access to credit, especially starting from March next year, because these so-called responsible lending laws have been enforced for quite a while. And in fact, it was these lending laws that caused the biggest correction we saw in the Sydney and Melbourne markets between about 2017 to 2019. Those responsible lending laws are being abolished as of March next year. Now, as a result of that, many experts predict that the amount that people can borrow will increase by about $70,000 to $100,000. So, what do you think will happen if people can now borrow an extra, say up to $100,000, even $70,000, without needing to earn any extra money, without needing interest rates to drop in any further? What do you think that will do for demand? And remember, when it comes to prices rising, ultimately it's all about supply versus demand. And we have all these factors here that are constricting supply, bringing supply down while increasing demand. All right. So with all this data, I'm going to actually come out and say that our next Australian property boom started in October of 2020. And I believe this is just the start of a extended period of price growth, and I think the rate of price growth is going to increase, especially post-March when these lending restrictions are abolished and more people can access a property as well. Now, in terms of areas though, I think it's going to be a little bit different this next property boom. I think, and I've said this in past posts, I think it'll be Brisbane and areas of Queensland that will lead this next property boom, especially because Brisbane essentially missed out on the last one. So prices have been flat for so long and they've got so much demand and the population is growing, driven by domestic migration. They're not dependent on overseas migration like Melbourne and Sydney, which I think will hold those cities back a little bit longer until migration can resume again, and then expect to see prices rise. So having said that though, there has been a particular type of migration that almost no one has been talking about. I'm going to call that reverse migration. See, over the last 7 months, we have seen approximately, depending on which report you read, but approximately 450,000 expats returned from overseas. Now, these are people often with bringing overseas dollars with them. They're on good incomes or good, and especially good borrowing capacity. And so they've been snapping up a lot of property in really, really good locations. Okay, now I know that hasn't translated to all areas, and no, but what it has done is place a further drain on demand as people from overseas are returning and buying up property very, very quickly. And then we have the fifth factor that I mentioned at the start. And I think this is the biggest one because it pertains to the Reserve Bank of Australia, the RBA. Normally, the RBA, they're a bit cagey in what they talk about in terms of their intentions and everything else. But this time, they've just come out flatly and just said it. So look at the statement from 2 weeks ago, which says, the RBA's lock-in of lower rates for longer at a time of relaxed, responsible lending rules is expected to reignite the loan market and house prices. Right? They're expecting it to reignite the loan market and house prices. In fact, Dr. Lowe then said record low rates were locked in for at least another 3 years because the bank would not raise them until the actual, not forecast, but actual target inflation was reached, and this next part is key. Asset price bubbles could now actually help boost economic growth. So in other words, our RBA governor is flat out coming and saying we want house prices to rise because it's good for the economy, and we're going to do whatever it is that we can to make sure that happens. So then we come to the announcement that happened today, the 3rd of November 2020, and we know the Reserve Bank of Australia, yes, dropped interest rates, but it was by 0.15%, not a huge deal. However, the big thing was they pulled the trigger on another $100 billion of quantitative easing. Now, what's quantitative easing or QE as it's known? It's essentially money printing. It's a way of giving more liquidity into the market, forcing banks to lend more money in order to stimulate asset prices and economic growth. Okay, so the Reserve Bank Governor Philip Lowe said the action, when he talks about the action, he's talking about the $100 billion quantitative easing project that they've taken on. He said the action was taken primarily to lower the cost of borrowing to stimulate the economy. Now remember, whenever cost of borrowing comes down, house prices and asset prices generally rise. He goes on to say, the combination of the RBA's bond purchases and lower interest rates across the yield curve will assist the recovery by lowering financial costs for borrowers, contributing to a lower exchange rate than otherwise, and supporting asset prices and balance sheets, Dr. Lowe said. At the same time, the RBA's term funding facility is contributing to low funding costs and supporting the supply of credit to the economy. To date, authorized deposit-taking institutions, i.e. banks, have drawn $83 billion under this facility and have access to a further $104 billion. So 83 plus 104, $187 billion worth of money that's sitting there with the banks that they want to lend out. So what does all this mean? Well, it simply means that the RBA is willing to do whatever it can to have house prices increase. So there was a lot of data there. So let me quickly summarize. There were 5 factors pointing towards why I believe we will have a significant property boom, and I believe we've already in the early stages. It's already started. So let's look at those factors. Number 1, current undersupply in the freestanding house market of about 10%, according to CoreLogic. And whenever you have undersupply, which means you have more demand than supply, that's a good indicator of future price growth. Number 1. Number 2, lower approvals for new dwellings, according to the HIA, which again will fuel this undersupply and continue to build that gap between where demand is and where supply is. And that's what, as I said, points to higher price growth. Number 3, we have record low interest rates. Number 4, easier access to credit than ever before, and it's going to get easier again by March 2021. And then finally, increased liquidity from quantitative easing or QE, i.e., as I said, money printing. So the Reserve Bank of Australia is literally saying we're going to make as much money as available out there at a time when interest rates are low, at a time when it's easier as possible to get that money in order to stimulate the economy. Now, whether you and I agree or disagree about whether that's the right approach, the fact is it's all pointing towards good news for property investors and pointing towards prices to rise. And the only question is, which side of that equation will you be on? Will you be someone who looks back and wishes they had jumped into property? Or will you be someone who took advantage of the opportunity in front of you, especially when you consider that with rents rising in the freestanding house market, not the apartments, the house market, coupled with the low interest rates, you can get neutral to positive cash flow while also getting capital growth. It's almost the ideal situation for an investor who can find these amazing opportunities. So I certainly think that now is a time to start looking. Don't get left behind. Don't be the kind of person who looks back in 2-3 years time saying, God, I wish I had bought something. Start doing your research, and I wish you profitable property investing. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.